More on bond yields. Realized compound returns versus yield to maturity. Um, the, the realized compound return involves reinvestment. The um, it's the compound rate of return on the bond with all the coupons reinvested until maturity. When we calculate a bond price, it assumes that we are able to reinvest at the yield on the bond. It's just a necessary assumption for calculating the price. Um, However, in most cases, that is not the case. We use what is called horizon analysis. Horizon analysis analyzes bond returns over a multi-year period based on forecasts, the bond's yield to maturity, and investment options. If you think about in today's market, and say you have a bond that yields, 6 or 7%, the likelihood that you're going to be able to reinvest that money at a similar rate is very low. So you would want to use horizon analysis to analyze your investment. Reinvestment risk is simply the uncertainty surrounding the cumulative future value of reinvested coupon payments. So um, we're all familiar with reinvestment risk. If an investment earns income at a higher rate and rates have fallen, then reinvestment risk is going to be an issue. If rates have risen, then we're happy, and the value is going to be greater when we reinvest it. So, Figure 10.5 is an example that shows the impact of reinvestment rate risk. We have a two year bond with a 10% coupon. Just to explain the cash flow, we're going to receive $100 at the end of year one, and then we're going to receive the face value of $1,000 plus that $100 of interest at the end of year two. If the reinvestment rate is 10%, that this coupon, we're going to earn 10% on that coupon. And so at the end of 2 years, we will have received the $1,100 plus $110 or $1,210. And B, our reinvestment rate falls to 8%. We're going to receive the same cash flows. However, we're only going to earn 8% on this reinvested coupon. So we're going to end up with $108 versus versus 110. So we'll end up with $2 less due to reinvestment risk. Bond prices over time. The yield to maturity versus holding period return. Yield to maturity measures the rate of return that measures the average rate of return if the bond is held to investment matures. Holding period return, which we've calculated already this semester, measures it over a particular period of time. Depends on the market price at the end of the period. So we're going to take into account the income we received, the price we paid for it, and the price we sold it for. So that's the same formula we've seen before. So it would be any coupon payments received plus what we sold it for minus what we paid for divided by what we paid for it. So Figure 10.6 shows the price paths of two coupon bonds. We've got a 12% coupon bond here, and a 4% coupon bond here. The yield to maturities are all calculated at 8%. So we got 30-year bonds, and the price of that 12% bond at year zero is over 140%. The price of that 4% bond is below 60%. But as as the years pass, the price of the 4% coupon bond increases. The price of the 12% coupon bond declines until At 30 years, the value of those bonds is going to be the same, the par value of those bonds. Zero coupon bonds, we mentioned these previously. Also, one form of zero coupon bonds and the most prominent form of coupon bonds are what are called U.S. Treasury strips. Zero coupon bonds, as we mentioned before, they pay no coupons. They provide an annual return in the form of price appreciation. U.S. Treasury strips are strips is an acronym for separate trading registered interests and principles of securities. So the Treasury does not issue strips. Strips are created from U.S. Treasury securities. Investment banking firms take a specific maturity of U.S. Treasuries and they strip out the coupons and the principal and sell them separately. So they convert what is a coupon bond into a series of different securities. For example, if we own a 30-year Treasury and we convert it to strips, we are creating 61 new securities because there's going to be 60 coupon payments, and there's going to be the face value or maturity value of that security. The zero coupon figure 227 shows the price of a zero coupon bond over time calculated at 10% yield maturity. The price of a zero coupon bond, a 30-year zero coupon bond, is going to be very, very low. So, and year zero, it's going to be less than $100. Over time, it's going to increase to the face value of that security. As you can imagine, because there are no coupon payments, the volatility of a 30-year zero coupon bond is much greater than that of a 30-year coupon bond.